name's Andrew Hallam. I'm the author of Millionaire Teacher and Millionaire Expat. This is part 5 of our Investing for Beginners series. The question here is, why do index funds beat most actively managed funds? And how do we know index funds will continue to win? In part 4, I talked about how index funds beat the vast majority of actively managed funds. I said that actively managed funds that win during one time duration typically go on to underperform during the next. So it's so much smarter just to own a diversified portfolio of low-cost index funds or ETFs instead of going with actively managed products. Now, a keen observer might ask this question here. If there is such a thing as reversion to the mean, meaning that which does well during one time period will typically underperform during the next, then how do we know that index funds will continue decade after decade to beat the aggregate return of professional, actively managed products? Glad you asked that question. All right, let's look at money that's actually in the US stock market to start. We have in the US market the highest proportion of index fund investors actually invest in the US stock market because indexes have been around since about 1975 in the United States. About 16% of the money that's invested in the stock market is as a result of passive management, i.e. index funds. About 84% is as a result of active management. When I say active management, I'm referring to the actively managed money that's into day trader accounts, hedge funds, pension fund accounts, tactical asset allocation funds, any kind of actively managed fund or institutionally managed fund that is actively traded. So they constitute the market. If US stocks gained 8% in a given year, how much would the US stock market index have made? Well, if the US stock market index tracks the US stock market, then we know that if the US market made 8% in a given year, then a US stock market index would have made 8% that year as well, minus the tiny fee that's associated with an index fund. If US stocks gained 8%, how much would active management have made in US stocks that year? So again, active management, we're looking at the hedge funds, the pension funds, even the day trading accounts. What would they have made? Well, think about this for a moment. The market, the entire market, is a result of index funds plus the actively managed products. So if index funds ended up earning an 8% return, if the market indeed earned 8%, then we know for a fact that active management on aggregate on US stocks that year must have earned 8% before fees because they represent the market. They are the market. It's mathematically impossible for this group of active managers as a group to actually beat the market because they are the market. If US stocks dropped 5% next year, how would a US index have performed? Well, that's pretty simple. It tracks the US stock market, so it would have dropped about 5%. Of course, then there's the tiny fee that goes on with an index fund, so it would have slightly underperformed the US stock market index or the US stock market. How about this though? If US stocks dropped 5% next year, how would active management have performed in US stocks that year? If you said they would have dropped 5% as well, then you're catching on quickly. This is all been really nicely documented in William F. Sharpe's paper, The Arithmetic of Active Management. You can find it online. It's a Stanford-based publication. He's a Nobel Prize winner in economics. If actively managed funds didn't charge fees, how many would beat their benchmark index long term? Now remember, their aggregate results are the market because they are the market. So that means that essentially if the market earned a given percentage, roughly half of those actively managed funds would have beaten the market and roughly half of them would have underperformed the market because they are the market. After fees though, how many actively managed funds beat their benchmark indexes? Doesn't look as good for them now. Over a 15-year period, according to the SPIVA scorecard, about 10 to 15% of them outperformed their benchmark indexes over a 15-year period. Remember though, The ones that outperform during one 15-year period typically aren't the same ones that go on to outperform during the next 15-year period. This is called reversion to the mean, and it's why it really doesn't make any sense to invest with actively managed funds. Why do index funds beat most actively managed funds? Remember, active management on aggregate is the market. They represent the market. If the market earns 5% in a given year, then they as a group must have earned 5% in that particular market stocks. Then we deduct fees. Active management costs much more money than an index fund costs. The expense ratio on them is far higher, the trading and the research, and of course the profits that they skim off for the financial services industry. And then of course we have reversion to the mean. That which does well during one time period, if it's an actively managed product, typically goes on to underperform during the following time period. In part 6, we're going to talk about what percentage should you have in stock versus bond market indexes. My name's Andrew Hallam, author of Millionaire Teacher and Millionaire Expat. If you'd like this video, please click like, subscribe to my channel, post in a question or a comment, and I look forward to sharing this journey. Everyone stay safe. Thank you. Bye-bye.